China's social-economic crises. The world's second-largest economy and consumer market has likely slipped into a recession, at least by China's standards. The country, which increased its GDP per capita every year for the past decades after severe lockdowns in response to the latest COVID-19 outbreaks, have resulted in a noticeable economic slowdown. Many economists have downgraded their China gross domestic product (GDP) growth targets for this year, citing risks from the zero-COVID policy. Most notably, the International Monetary Fund recently lowered its China GDP growth forecast for 2022 to 4.4%, which was also highly expected as the year-end data is not good for fans of China's economy, well below the government's target of about 5.5%. The most dramatic of these recent lockdowns saw tens of millions of people confined to their homes in Shanghai during April. Data to be reported this week on April's retail sales in China is expected to show a drop of negative 7.5% from a year ago. But there may be even worse news. China reported a steep drop in tourist spending for the 5-day Labor Day national holiday in early May. Tourist spending was down 43% from the same period last year, according to the Ministry of Culture and Tourism. Caixin Services Purchasing Managers Index, a closely watched indicator of the services sector of China's economy, plunged to 36.2 in April from 42 in March. Below 50 indicates contraction. The impact is considerable as the services sector accounts for more than half of China's GDP and over 40% of the company's employment. While the extent of the contraction was not as severe as the nationwide lockdown during the initial outbreak in February 2020, the sudden drop is beyond a normal cyclical fluctuation. With China's manufacturing sector also shrinking last month, it appears that the world's second biggest economy may have gotten smaller in 2022. In the short term, China's economy outlook largely depends on the success of its COVID strategy. There are some indications that 2023 could be better than 2022. Around 16.7 million of Shanghai's 25 million people were allowed to leave their neighborhoods from May 2022 following a sharp decline in new cases. However, getting cases under control was difficult, and Shanghai increased restrictions in some areas over the past months. Beijing has been able to keep new case numbers to dozens per day, reducing the likelihood it would be subject to a strict lockdown, but curbs could still dampen consumer spending. Cities in China required residents to test at least once a week, striving towards shorter, more targeted lockdowns that may reduce economic costs in the coming months. The Chinese government's announcements of additional economic stimulus policies replacing the surge in regulations seen last year may not gain much traction until lockdowns ease and those incentives can be put into action. The potential for strong stimulus post-economic reopening can be seen in the quality and emphasis of new initiatives. For example, in February 2020, China's leadership called on officials to actively expand effective demand. But the tone in their early months of 2022, communication seems more aggressive, instructing all-out efforts to expand domestic demand. Signaling its unwillingness to surrender the 5.5% growth target for 2022 despite the recent sharp slowdown, the Politburo implored officials to work hard to achieve the full-year forecast targets. In the same April 2022 communication, China's leaders also addressed other issues of concern weighing on the economy. Most notably, they proposed to normalize regulation of internet platforms and deliver specific policies to support their healthy development, including a focus on supporting housing using a variety of monetary policy tools. In another sign of economic accommodation, China recently relented on key points of contention related to U.S. officials conducting on-site inspections of local auditors of U.S.-listed Chinese firms, diffusing the threat of delisting for Chinese companies listed on U.S. exchanges. More recently, though, a survey by AmCham Shanghai conducted at the end of March showed that 49% of companies say they will reduce investments in China if the current COVID restrictions remain in place into next year. China may be losing its edge. 60% of companies and 82% of manufacturers now report their production slowed during the present outbreak due to lack of employees, inability to obtain supplies, or explicit factory halts resulting from the lockdowns. Analysts polled by Reuters prior to October 18 had expected China to report GDP growth of 3.4% for the third quarter. The officially released 3.9% year-on-year growth for the third quarter marked a pickup from 0.4% in the second quarter. That's still well below the official target of around 5.5%. COVID controls on business activity, especially in the second quarter of the year, have weighed on growth and prompted many investment banks to slash their full-year forecasts to around 3%. The latest Congress did not signal whether the COVID policy would soon end or continue. Industrial production rose by 6.3% in September from a year ago, well above the 4.5% increase expectation by Reuters. Automobile manufacturing surged by nearly 24%, while the economy produced more than twice the number of new energy vehicles compared with a year ago. Industrial activity has been the source of strength lately, Goldman Sachs chief Asia-Pacific economist Andrew Tilton said on CNBC's Street Signs Monday. The big picture is still that the economy is operating well below potential this year. Fixed asset investment rose by 5.9% for the first 3 quarters of the year, a touch below Reuters' forecast of 6%. Investment in real estate declined by 8% during that time, greater than the 7.4% year-on-year decline recorded over the first 8 months of the year. Year-to-date investments in infrastructure sped up to 8.6% year-on-year growth as of September, from 8.3% as of August. That in manufacturing held about the same pace. The urban unemployment rate ticked up to 5.5% in September. That of people ages 16 to 24 remained far higher at 17.9%. For the first 3 quarters, per capita disposal income of urban residents rose by 2.3% year-on-year when accounting for inflation. That's an average monthly disposable income of 4,165 yuan, $587 for city residents. Income varies greatly in China by city size and location. Overall, the data reflected the impact of COVID controls and the real estate slump, while the automobile industry remained a bright spot under Beijing's support for new energy vehicles. Retail sales grew by 2.5% in September from a year ago, slowing from August and missing expectations of 3.3% according to the Reuters poll. Within retail sales, those of catering fell by 1.7% in September from a year ago. Furniture, home appliances, and construction materials also dropped last month from a year earlier. However, sales of autos, one of the largest categories by value, surged by 14.2% in September from a year ago. China's economy will likely grow more than 5% next year if the COVID disruptions are handled properly and the government rolls out more policies to boost confidence and consumption, according to an advisor to the People's Bank of China. The gross domestic product growth estimate from Wang Yiming, a member of the PBOC's Monetary Policy Committee, is the latest forecast from a prominent Chinese economist as the government tries to help economic activity recover from this year's slowdown. He was speaking via video to a conference on Wednesday organized by the Hong Kong Institute of Monetary and Financial Research. China took things seriously and decided to loosen the COVID restrictions from earlier this month. COVID-19 testing booths were removed in Beijing, while Shenzhen followed other cities in announcing it would no longer require commuters to present their test results to travel as an easing of COVID restrictions in China gathered pace. As daily cases hovered near all-time highs, some cities took steps to loosen coronavirus testing requirements and quarantine rules as China looks to make its zero-COVID policy more targeted amid an economic slowdown and public frustration that has boiled over into unrest. Cities including Guangzhou and Beijing have taken the lead in making changes. Also, earlier this month of December 2022, the southern city of Shenzhen announced it would no longer require people to show a negative COVID test result to use public transport or enter parks, after similar moves by Chengdu and Tianjin, among China's biggest cities. Many testing booths in Beijing were shut as the capital stopped demanding negative test results as a condition to enter places such as supermarkets. This rule has also been applied to subways, although many other venues, including offices, still have the requirement. A video showing workers in Beijing removing a testing booth by crane onto a truck went viral on Chinese social media. Some Beijing neighborhoods posted guidelines on social media on how positive cases can be quarantined at home, a landmark move that marks a break from official guidance to send such people to central quarantine. China is set to announce a further nationwide reduction in testing requirements. As of now, the economic growth of China is at 3% from last year. And it's still very interesting to keep an eye on the Chinese economy to see how they handle the current economic crises in the country when the people of the country now seem to be frustrated by the COVID restrictions.